Hi, everyone. Welcome to the Financial Dad podcast. On this show, we make personal finance easy and understandable because we all know that some of these topics are way over our head. We talk about some of the biggest topics plaguing young people, millennials, college students, even high school students, and how to navigate a wild, changing financial world. My name is Bridget Sisko, and I'm here with my dad, Tim Smith, a certified financial planner, to talk a little bit about inflation today, how we can navigate it. But before we go into that, hi, Dad. Welcome.
Hi, how are you?
I'm good. This is our first episode. So we definitely have to tell a little bit of a backstory on how we started this company, The Financial Dad, but a little bit of, your story into the world of financial planning and how you've learned some of these topics for yourself.
Well, sure. Just by way of backstory, I grew up in a family where there wasn't much financial knowledge, and there wasn't much in financial means either. And I was fascinated by it. And as a teenager, I happened to be on trains going back and forth to New York City, and I would see people reading the business pages of the New York Times or the Wall Street Journal, and I was fascinated by the stock market tables of stock prices that used to be in the newspapers back then. I when I finished college, I was so fascinated by it that I decided I wanted to go into it as a career, and have focused on it now for going on 39 years. So it's been a long time. Obtained the certified financial planner designation. I've worked with hundreds of families on their personal finance. I continue to work with families, but most of my work for the last 25 years has been helping other financial planners with their practices and in working with clients. So I've seen the financial planning industry from sort of both sides of the table, meaning what the client sees and then what's in the background of everything the client sees. I guess I haven't seen it from the client's perspective directly, but I've been involved in the industry for almost 40 years at this point.
Wow. It was super interesting. Obviously, growing up, this is what you did for work. But I will say, I don't even think I understood what you did until I was in my late teens, probably early 20s, to even like wrap my head around what this was. And I'll never forget, we were at a Easter brunch, and we were all just sitting together as a family. And I have two siblings. I'm the oldest of the three of us. And we're all talking about the financial education that we didn't really get, even though our dad was the financial dad. And, we'd all gone to good schools and good colleges and, high schools where you would think they would talk more about this. I just don't even remember if they did. And there was this just huge missing gap between education and what kids are learning. And, I've talked to many of my own friends. They still lack some of the basic financial education.
Mhm.
What really is a 401k? How to contribute to it if you're self-employed, yada, yada, yada. But I think that was a really interesting just aha. And it kind of led us to wanting to, start this company where we can bring financial literacy curriculum to college age students, high school students, and millennials, because there is a big gap in that industry.
Absolutely. And you are not alone in your experience. As I talk to people, especially parents, the parents themselves lack financial knowledge. And so they're not really able to pass it on to the kids, and the schools largely do not provide it. And therefore, we are where we are, where there's just an enormous gap in knowledge of personal finance. And you and I have kind of joked over time about what are simple financial concepts to me, because I've dealt with them for decades. And you go like, oh wow, that's so cool. That's so simple. It's even the basic things are to me, just things that I don't even think about on a day-to-day basis anymore. But so many people have not been exposed to them in an educational fashion, a way designed to increase their understanding of them.
Mm-hmm. Yeah, I'm sure we'll do more episodes. I mean, I'm self-employed, so I've really struggled to understand some of these financial things for myself when I don't have a company to match my 401k or, company benefits and all that. So I'm sure we'll do a separate
Right.
episode, about that. But before we did start the company, we did a survey of young people to just gain like an understanding of the landscape and what people were understanding. And those results
Hmm.
were interesting. And, we kept doing some research, and I found this stat that according to Forbes, only 24% of millennials in the US understand basic financial principles. Like, obviously, that's a problem.
Amazing. To think that 75% therefore don't understand basic financial principles. How are people supposed to go forward in their lives and make wise financial decisions with no knowledge of these things? And even the basic things, as we were saying earlier. So I think it's critical that people learn it, and for me, it's a mission. My own children didn't know it, even though they, I guess I thought by osmosis you all would kind of, learn it or something. And of course you didn't. Um, so not only do the children, the cobbler's kids have no shoes, right? You guys didn't learn it from me because it was never specifically said, hey, we need to know this information.
Mhm.
Um, and Most kids, obviously the vast majority of kids are not the child of a financial planner, so they're not learning it either. And That statistic is just points to it, and that statistic is very similar to the research that we did, where we found a similar percentage of people had not been exposed to any financial literacy education all the way through college,
Mhm.
which
Mhm.
is that's exactly where it is. I mean, reading, math, arithmetic, um, social studies, history, science, it's all important stuff, but this is also. And I think what I like about what we've done with the financial dad is we're giving people a very good grounding in financial matters in a very short period of time. And as you always like to say, we're giving it to them the way that they want, the way that they want to learn.
Yeah. Yeah. So I'm, for anyone listening, I'm 30 years old. My younger sister is 25. And the way I consume information these days is through podcasts. It's on YouTube. It's video material that not only explains a topic, but talks about the application of that topic. And I think that's probably what the school system never really did. They would give you maybe a topic or information, but not necessarily the practical application of knowledge. So today, we're
Mm.
going to go into talking about really one of the hottest topics for not only young people, but everyone in this world, and it's inflation. And I have many questions that I want to ask, and we hope that anyone who's listening to this just receives the information that you need to hear in a practical way, because everyone needs a financial dad. So true.
Yes, yes, everyone does need it. That's for sure.
Everyone does. So let's go over like the basics. I mean, what is inflation?
Well, okay, so inflation is just simply a phenomenon where the prices of things rise over time. And it is expressed as a percentage, typically percentage versus the prior year, as to how much prices have risen. Um, and hopefully our incomes keep up with that rise in prices. But so just for the basic things, as an example, you know, um, bread, milk, uh, homes, services of various kinds, gasoline, the staples of life. The government measures and creates something called the Consumer Price Index, and that is how they measure how much prices of goods and services are rising at what you would call the retail level, for the average person in the country.
Mhm.
Um, and the issue that we've had is that whereas these prices, the government shoots for roughly a 2% per year rate of increase in inflation, um, we've seen in the last couple of years upwards of 9%, 8%, 7, 6, 5, percentages that are far above the norm and far above what the increase in people's incomes has been. And that's really the issue with it. In other words, if I'm making $40,000 a year and prices rise by 3%, which would be $1,200 more a year for costs. But if my salary doesn't move at all, it stays at 40,000. Well, I have in effect $1,200 less to spend. I have less spending power than I had the prior year. And it's so, if for the sake of argument, if I was living paycheck to paycheck on $40,000 and my income doesn't go up, but the cost of things goes up, I will now be behind
Mm-hmm.
because I can't afford at least $1,200 worth of goods that I could have afforded the prior year. On the other hand, if I'm making $40,000 and as a salary, let's say, and my salary goes up by 4% or $1,600, and the price of goods and services goes up by 3%, $1,200, then my increase in salary is just about enough after you pay taxes on the salary increase. It's just about enough to stay even.
Mm-hmm.
So, and when I say even, that means the same quote unquote standard of living. We use this term. And in simple terms, it means the ability to spend and afford the same things that you could spend money on and afford the year before.
Mm-hmm. Mm-hmm.
So if in the first example I gave, if your income did not go up and you have $1,200 of increased expenses, your standard of living goes down.
Mm-hmm.
Your standard of living goes down, we say. But if you have a 4% salary increase and that exceeds the 3% inflation rate, then we say that your standard of living is roughly the same, maybe slightly better.
Mm-hmm.
So what you want ideally is for your income to stay at the same rate of growth or increase per year as the rate of inflation, as the rate of what things cost for you to live your life, to live your standard of living. So that's the key to the entire thing. What is the inflation rate? And then what is the rate of your increase in income, if any increase? And that's where people have really been hurt in the last several years in the post-COVID environment, because there's been a huge increase in the rate of the costs of things. And I say huge, 9%, for example, was huge. That is a
Mm-hmm.
very big increase in the cost of things. Whereas people's salaries were only going up, 2 or 3%. And if you think about it, this is just as a concept, right? If I own a business and my costs are going up at 9% per year, if I give 9% salary increases, that just increases my costs as well, and my profits could be diving, or I could be losing money at that point.
Right.
So in general, business owners don't increase wages as fast as inflation. They try not to,
Mm-hmm.
because it hurts profits. It hurts their ability to stay in business in many cases.
Right.
So that's why we end up, when there's inflation, it's the people whose incomes are not increasing as fast as the rate of inflation that have less spending power and have a reduction in their standard of living. They're the ones, if you, our next topic is who gets hurt the most by this kind of thing. So I'm just going straight there. The who gets hurt, just to start with that, is people whose incomes don't rise as fast as the rate of inflation. So if my percentage rise in my income is not as great as the percentage rise in the costs of goods, things that I need to sustain my standard of living, then my standard of living goes down and I get hurt. Now, who gets hurt most by it is people who had been living, as we say, paycheck to paycheck.
Right.
They weren't saving money. They were really just barely covering their expenses before. Now, suddenly, their expenses have risen faster than their income. Without something changing, those people will go into debt.
Right. Mm-hmm.
They simply won't have enough money um, to pay for for what they need for what they bought a year prior, the
Is
same
there
things
a
they bought a
limit
year
to
prior.
any of this? Like, does this ever end?
Well, we're going to get into some technical things, but what happens when there is high inflation is that governmental entities do what they can to try to reduce the rate of inflation. The primary way that that is done is that the Federal Reserve, which is quasi-governmental, but uh, they control interest rates in the country. They will raise interest rates, which is what they have done
Mm-hmm.
in an effort to slow down spending by the public, to slow down these increases in prices. Because inflation, the basic cause of inflation is too much money chasing too little goods, so the prices of the goods goes up. And we can get into the causes of that, what happened post COVID that caused that, um, which is basically the problems of supply, meaning that it was very difficult for companies logistically to bring their products to the retail marketplace because there were such disruptions in what's called their supply chains.
Right.
So, for example, getting things from on ships from China to the United States and getting them out of harbors in the in onto the shore in the United States was very, very difficult. So cars, just as an example, there weren't that many cars for people who wanted to get new cars. And with supply and demand and the law of economics, when supply is down and demand is up, or demand is the same, prices rise.
Right.
So you had a lack of supply, and then the government late in I'm going to say 2021 early in early spring of 2021 gave out about $1 trillion to the public as COVID relief, and so now you had that much more money again chasing fewer goods, and that's what causes inflation. It's very simple. It's very simple, but that's the way that it what caused it.
Right.
So now getting back to the point of it all, the Fed tries to slow down that spending and raises interest rates. And as a result of that increase in interest rates and the slowing of spending, the rate of inflation comes down, which has been what we're seeing.
Mm-hmm.
Inflation is not as bad as it was a year ago, for example, and things are getting better, but people are still struggling.
Yeah. I didn't realize that the Fed increases the interest rates to slow down spending. Like, I didn't know that was why. I mean, I've only seen this really obviously with like regular goods and services, but especially with the housing market. I'm sure that people listening can see that as well. If you were looking for a house, or even wanted to get a your first home, it was very expensive to be able to pay that mortgage because of the high interest rate. So I didn't realize
Yeah.
that they raise it on purpose to try to slow down the spending to kind of bring us back into balance. That's very interesting.
Yeah, and that's how it's done. And if you think about this for a second, the cost of a house is not the cost of the house for the
Right.
vast majority of people. The cost of a house is the monthly payment on the house for the
Mm-hmm.
vast majority of people. And so if you increase that cost, you'll get less of the purchasing of it, whatever it
Right.
is. Again, laws of supply and demand with economics. And so um, raising the cost of housing, for example, slows down the purchases of housing. And you slow down the purchases of housing, you slow down the purchases of goods for a house, everything that goes into a house. When you buy it and you want to put a new living room set in, or a new bedroom set, or whatever it might be, that slows down. And then companies also have to pay more money to borrow to grow their companies. And as a result of that, they don't spend as much to grow their companies. So
Right.
that growth, that spending slows. And the big picture thing that is at issue is, well, how do we slow the spending enough to reduce inflation, but not so much that we cause a recession, that we start to go backwards financially.
Mm-hmm.
And so far, they have managed not to send us back financially. So interest rates have just begun to fall. Um, the Fed has announced that it will increase rates further if it has to, but it did not increase rates at its most recent meeting. And it appears as though we may have peaked with these interest rate increases, and that they think that the rate of inflation will continue to come down. That's not much solace to people who are struggling
Right.
with the inflation that we've had in the last couple of years. So I think this is still a timely topic, and I think that working on how you can protect yourself against this inflation is still something that needs to be dealt with by people. But at the same time, as interest rates may begin to be dropping and inflation has definitely dropped, uh, economic activity has slowed, but has not started going backwards, which would
Mm-hmm.
be the definition of a recession. It hasn't lessened overall. So at the moment, they're accomplishing what they're trying to do at the Federal Reserve level, and hopefully it will work. Hopefully we will not see layoffs and increase in unemployment because they went too far and they damaged the economy with the interest rate increases.
Right.
Um, but that lever, using the rate of interest rates in the economy, is the main way that government controls growth versus recession
Wow.
overall as an
Do they do
economy.
this in other countries too? Is this a similar structure, or is this really just like United States based?
It's very similar in other countries as well.
Interesting. Okay. So
In market-based economies.
what does that mean?
Well, if you're in a communist country where the government controls the cost of goods, the government can just stop controlling the cost of goods. But ultimately, what happens is you have a currency devaluation. It's a little technical.
Okay. Okay.
Um,
Yeah, you're
you
going
know,
over my head now. We'll pause. We'll go deeper on another day for that one. But
okay.
okay, so we're about to go into what you can do, and we'll just say as a disclaimer, this is for educational and informational purposes only. This is not, personal advice. And this is something that's very unique to the individual, right? Because it really is going to depend on, how much money are you making? What does your debt look like? What are your fixed, what's the fixed expenses that you have? What are the variable expenses you have in your life? Like how much money are you making?
Ooh, you sound pretty good there, Bridget. You're using the
Well,
right terminology. Very good.
because I had to learn for myself. So I'll just say before we even go into the what can you do, there is a little bit of personal responsibility here. You do need to, like anyone listening to this podcast, I really applaud you because you do need to know these things. It does impact your life. And, you might learn this in school, but you need to also understand these in your own life and in your own world and what it looks like for you as an individual. So
Yeah.
yeah, just equipping the actual individual to take responsibility for the fact that they need this information and then to
Yeah.
actually apply it.
And to your point, uh, not every point I will make could be possibly done by every person. It's very situational, as you said. Um, and these are really things to take up with whoever can give you financial advice in your life.
Mhm.
These are not intended to be financial advice. Okay, go do these things and you'll be fine. These are intended to be ideas that you could take to a third party who can give you some advice on how to move forward.
Yeah, yeah. All right, let's start with the basics. What can we do about inflation? What is the
Oops,
financial
sorry about that.
pressure for each person?
Yeah. Well, there are three parts to all of our income picture as individuals. You have the gross income, which is the total amount of money that you earn. Then you have the deductions and taxes that come off of your gross income. And what that gives you is what people refer to as net take home pay. In other
Okay.
words, how much money you actually then have available to spend or save, to
Let's do an
spend on your
example of
monthly
it.
expenses.
Let's say
Yeah,
that
sure.
someone, okay, maybe first job, second job out of college. What's the gross? Let's just say a number.
Yeah. So imagine you're making $50,000 a year.
Gross.
Okay. Gross. That's your gross income. Okay. And maybe there's a bonus, but let's just assume in total it's $50,000. Now, from that are deducted a series of taxes and costs. So, for example, you have federal income tax. Many states have an income tax. You have FICA tax, which is essentially Social Security taxes.
Mhm.
Some states have disability insurance taxes or unemployment insurance taxes. So all the individuals that work in a state, are paying all of these things. And these are the little line items on your paycheck. If you're getting a paycheck on a bi-weekly basis, let's say, these are those little line items where they're taking away money from you. So let's say out of that $50,000 of gross income, there's a total of roughly $7,000 of tax deductions.
Mhm.
Now, you may or may not also be saving money in a 401k from your gross income, or some companies do things like, you can buy treasury bonds, or you can donate to the United Way, charitable things like that, through payroll deductions, stuff like that. But let's just say in total, all of that adds up to $7,000. Okay. All you have to do is take your $50,000 of gross income and subtract that $7,000 from it, and you have
Three.
$43,000.
Mm-hmm.
And that is your quote unquote net take home pay.
And then
And
even
from
we
that
can divide that.
43,000, yeah, you divide that by 12-ish, right? Depending upon your bonus, since that comes at one time, but you're living on roughly the amount of 43,000 divided by 7,000, or roughly $6,000 per month, a little bit more than $6,000 per month. And that's, yeah, I'm sorry,
Less.
forgive me. I am,
Less. I think
I'm not
3,800.
doing math well at this hour in the morning.
I think
You're right.
it's
So
3,800-ish.
3,800. Yeah. Yeah. It's like $3,800 a month. So, in fact, it might not even be 3,800.
I
I
did
don't know
some
why I
rough
can't
math.
do math. Yeah.
I think it's
Yeah. I
like
know.
somewhere in that.
35 to 30, 3,512, something like that,
Yeah.
per month.
Someone fact check
So
us.
yeah, dear Lord, uh, we're doing this in the morning, and haven't had coffee, so I should
3583.
have had that cup of. Yeah, okay, 35.83 per month. So that's your take home pay, and from that, you have to do things like pay for rent or a mortgage, or property taxes on a mortgage. You have to pay for insurance of various kinds, a car if you have transportation by car. Um, you have to pay for food and utilities, et cetera, et cetera. So if you go to our budgeting episode in the Financial Dad, you'll see, some very good suggestions of what all that would be. And then on top of that, hopefully you're saving money. So not on top of the 35.83, on top of all the money you're spending per month, hopefully you're saving some money. But so just so the concept is clear, the gross income, $50,000, the total expenses for taxes and deductions, $7,000, the net take home pay, $43,000 per year, or just under $3,600 per month.
Right.
So that's what's available for spending and savings.
Mm-hmm. Mm-hmm. Okay.
Okay. Now to go to the inflation example, let's assume we're not saving any money. Young people right out of college, or they're often trying to save some money towards just an emergency fund, let's say, or vacation fund, or ultimately to buy a house, things like that. Um, but let's just say that you're roughly, let's say you're saving $2,000 a year of that. So out of 43,000, you're saving 2,000 and you're spending $41,000. Okay. If we have 9% inflation one year, which we had recently, 9% of $41,000 is $3,600 and something and
Mhm.
change. Okay. So whereas you were saving $2,000 a year in year one of our example, now that $2,000 is gone and you're in the hole for about $1,600 because your costs went up by $3,600.
Yep.
And if your salary did not go up, you're in the hole by about $1,600. And on top of that, you're obviously not saving any money anymore.
Right.
You're not able to save money anymore. So inflation hurts people without discretionary income the most,
What
as
does
I
that
said
mean?
before.
What's
Okay,
discretionary?
well, imagine you're making $1 million a year and you're saving, $100 or $200,000 a year.
Right.
Okay. Okay. On $1 million, 9% inflation. Well, your costs, by the way, we're trying to give examples, so it's a little more technical than I'm making it here. But if you're only spending, let's say, $600,000 because you have taxes and then savings, 9% of that is $54,000. So you go from saving $200,000 to $150,000. Wow. you know,
Hmm. Hmm.
and you're probably still going on vacation and you're probably still, doing all the things that you were doing before because that's built into the $54,000 of inflation.
Yeah.
So, a person making $1 million a year, probably not very badly impacted by inflation. Person making $50,000 a year is probably hurt by inflation.
Mhm. So it feels like a dire situation for many people. Like it even as we're
Yes.
talking about this, I'm like, oh damn, like this has to be really hard for some people. So let's bring the light at the end of the tunnel. There are things that we can do. Of course, we mentioned that it might not apply to everyone, but I think there are ways that we can get creative, work a little bit smarter here. And I think understanding these concepts is going to help. So yeah, what can we start to do? What are the ways to deal with this?
Yeah. Okay. So, let's start by looking at that income level. And again, I just make the caveat that not everything that can be done that I'm going to suggest is possible, but these are the things that people can try. These are 10 things that people can try to do. So starting with that gross income number, the most obvious thing is, can you get an increase in your income that helps you stay up with inflation?
Mhm.
So if you have a salary, for example, can you renegotiate that salary to get it to rise as much as inflation has risen? We're much closer to inflation so that there's much less of a difference between your spending and your savings, your increase in income and the increase in inflation. So that's the first thing. See if you can renegotiate your salary and bonus so that you can uh, keep up with the rate of inflation.
Yeah.
The second thing is, if you can't renegotiate that, say, for example, you're an hourly worker, again, because hourly workers, um, people in the less than $100,000 a year level in general, they are the ones who are most hurt, and need to take the most action. So if you can't get an increase in your base rate of pay, the next thing you could try to do is to get more hours. Now, this isn't fun.
Right.
This isn't what you want to do. This changes your standard of living, as some of these ideas do. These are ways to deal with it, but they're not all pleasant. They're not all, way pie in the sky stuff. So, can you increase your hours? Would be the second thing. Third thing would be, can you take on some other work, some additional work somehow
Yeah.
that would give you enough of an increase in your gross income so that you can still pay the bills, and hope that over time you can catch up another way.
Hmm.
So, in dealing with your gross income, those are several ways that you can try to uh, deal with your income situation and the inflation situation by increasing your gross income.
I have a question
Now,
about
let's say
that.
that, yes, okay, sure.
I have lots of questions as you're talking. So
Okay.
what are the reasons an employer would not be, I mean, you might have already kind of touched about this in the beginning. Why would an employer not be open to negotiating the pay raise? Would it be because they're also struggling, and if they increase the employee income, then their expenses are going up, so there's not as much, like it's almost like everyone's struggling, whether it's the business or the individual.
And you're precisely right. Businesses are struggling as well because their cost is going up faster than their revenues.
Mm-hmm. Mm-hmm.
So it's the same concept. It's just in a business context rather than a personal context. If I run a business and if let's just say, for example, I don't have a lot of profit, if I'm sort of squeaking by in my business at this time, and if all of a sudden my costs go up by 9%, but my revenue doesn't go up at all, or my revenue goes up by 3%, which is kind of what had been happening. That was sort of the rate of growth of the economy. Um, I'm probably losing money at that point. So I do everything I can to stop from spending more money. And that includes giving increases. In many cases, small companies may not be able to afford any increase,
Are
any
there
percentage increase.
any industries that don't seem as afflicted by inflation? Like, I have a business in the online world and the online space where I'm not really selling something that's necessarily necessary to live. But are there industries that seem to do better in times like this economically? Can't say it economically.
Well, think of it this way, there are certain things that tend to go up, um, and in the times of inflation, for example, the cost of oil.
Mm-hmm.
And oil as an industry does better in inflationary times because they have a fixed price at which they have drilled for oil and natural gas and the like. And all of a sudden, they're getting more money for that same oil.
Mm.
And so their profits tend to climb. That's an example of an industry in general, you could say, that does better in inflationary times, or can still do well, let's put it that way, in inflationary times. And the term that is often used in the industry or in general economics is hyperinflation.
Right.
This isn't just our normal inflation, 2% per year, 3% per year. When you get to 9%, that's hyperinflation, and it's damaging. So what you're getting to with your question is sort of, geez, well, who makes out okay in this? Doesn't
Mhm.
Isn't there usually a silver lining for somebody when when something's bad, something's good? The truthful answer is, with inflation, very few people do well with inflation. It's very damaging.
Mm.
And that's why governments are typically very, very aggressive to stop it. You hear stories about banana republics, for example, where they have hyperinflation of 1,000% per year. They're literally 200 or 20% a week. Costs are going up because their currency is devalued and things like that. Well, you know, that's where inflation can go.
Yeah. Yeah. That's
It can
interesting.
be that it can bring down a country.
Yeah. I mean, I've seen
And
some of
so
those videos on like Venezuela and some other countries that have dealt with wild amounts of inflation. Their currency is completely devalued. They start using the American dollar because at least um, there's a little
it's
bit more,
stable.
yeah, a little bit more spending
Yeah.
power. It is very interesting. Okay, we're going into the nitty
Yep.
gritty. Let's keep going.
Yep. Okay. Well, so now the next area of income, as I said, was your taxes and deductions, right? From before you get to your take home pay. So, is there a way to reduce taxes? This is a very, very big picture question, of course. Um, but there could be a couple of things that people can do here. One, let's take that person that was saving $2,000 a year And let's assume that person was not saving any money in a company 401k plan that was available to him or her. Okay. If that person were to rechannel that $2,000 into their 401k plan, they would save something like maybe $500 a year in income taxes by doing that. And that $500 gets added back to what they can now spend. They're still saving 2,000, but they're not spending $500 on taxes. So that frees up a little bit of money back to their, their net take-home pay, uh, available for expenditures without impacting how much money they're saving per year. Number one. Number two, chances are pretty good that there's a company match for a portion of that $2,000. So to get $2,000 saved, you might not even need to put in $2,000 because of a company match. You might get a $500 match on $1,500, say, and that's your $2,000 saved. And now you only have to put in $1,500. You're saving maybe $1,200 in taxes, or I'm sorry, $300 or $400 in taxes, something like that. And now you've saved about $800 to put back towards your cash flow to deal with inflation.
Got it.
So if you are not contributing to your 401k, but you are still saving money after taxes, that could be a way to improve your cash flow. Okay. Now, what you also have to do when you do that is change your withholdings.
And
In other words,
is that like the 0 or the 1 thing?
that is, yeah. Yeah.
See, this is how people are actually thinking, how I'm thinking. The 0 and the 1s.
That is correct, because a 0 or 1 may not be the correct number for you. The 12 might be the correct number for you, because that 0 and that 1 isn't how many people are you. You know what I mean? That's not what it's asking. It's asking you about deductions and in effect the value of those deductions against your taxes. So for example, mortgage interest alone might give you the equivalent of 5 deductions. So when you really have to set those deductions, properly. And in fact, that's one of, let me come back to that, because that's something I want to talk about. Now, a second way to do this is, let's assume that you are saving money in your 401k plan. Okay. Now, it's not ideal to give up saving money. Okay. But it's better to give up saving money than to go into debt. Just, debt is not debt. You got to pay interest on, and you got to pay the piper eventually. So if you are saving money in your 401k and you find yourself starting to fall into debt, like credit card amounts are going up and you're not able to pay them, etc., then another thing to do would be to stop contributing to the 401k.
Right.
Now, most financial advisors would consider this anathema as advice, because we want people saving every dollar possible. But what we really want is people's net worth to grow, meaning your assets minus your liabilities. And if you're saving money in place 1 and you're building liabilities in place 2, it may not be worth it. This is where financial advice can really come in handy. And the other way to look at that is, if you have a match to that money, then it's really hard to justify not continuing it. But you have to look at what's happening to your financial picture. And if you're starting to go into debt, it may be better to stop for a while, wait until you kind of catch up to things financially, and then start saving again at that point.
Right.
So that's another thing that you can do. You can also look at the deductions that you're taking and see if any of them are discretionary. So for example, if you are giving money to the United Way, or putting it into treasury bonds or something that's not taxes, something that's discretionary, it's at your decision to put it in or not put it in. Well, you could stop doing that, and that will result in more money come to your net take home pay. Okay.
Right. And I
So
think
for
back to when I worked in the city and it was my first job out of college, I didn't really understand some of these things. I didn't really get, some of these line items that were being taken out of the paycheck, every two
yeah.
weeks. So is this something that, if someone's listening and this is their first job out of college, or maybe, just a company a couple years out, should they talk to their HR department about making these changes? Like, what's the actual action step there?
Yeah, there's probably a form or there's probably an online site that they can go to with the payroll company
Yeah.
to make that change.
Okay.
But HR is the right place to start to find out how to make the change. HR may not make the change,
Okay.
but they can tell you how to make the change.
So we
So,
increased overall income, we reduced the taxes and deductions,
well,
then
we
what?
have one more thing that could help you on a month-to-month basis that I wanted to bring up, if that's okay, and that is that some people, because of the way they're using their withholding allowances, some people end up every April getting back, $1,200 or $2,000 in income taxes. And they look at that and they say, oh, good, I got a refund. But another way to look at that is, oh, look, I gave the government interest-free money to use for the past year. And all they're doing is giving me back my money that I didn't have to pay them in the first place. So if you're typically getting back a tax refund, you might also want to look at your withholding allowances and make a change there. Now, you may not get a refund back. You might owe a little bit, you might get only a little bit back, but at least you will add money to your monthly paycheck to help deal with the rise in costs.
Okay.
This isn't great if, for example, you had been using that money as a vacation. Usually you take that money and you spend it on a vacation or something else. This is where standard of living comes in to be an issue, but it is a way to deal with the monthly increase in expenses on a present basis, if you will, to try to keep up.
That makes a lot of sense. Yeah, right. Because if you are paying more in taxes on each paycheck, you don't have that as available cash to spend on basic things like expenses. Then you could be going into debt, credit card debt, because you don't have that cash, but then you're ending up getting it back with the taxes, the tax refund anyway. So you're saying
Right.
basically,
Well, and unfortunately, a lot of people won't turn around, take it, and pay off the debt. They'll leave the debt outstanding and spend the money on again a vacation or something like that. So it's better to avoid the debt in the first case, because debt is as inflation can be a spiral, debt can be a spiral.
Yeah.
Debt can just add up and add up and add up, and you wake up and realize, wow, I owe $10,000 in credit card debt. How the heck did I get here?
yeah,
You know,
yeah.
it's a
Okay.
problem.
Okay. All right. What else can we do? We have a couple more things here.
Yeah. Well, so now we're down to the net take home pay, the money you've been saving, the money that you've been spending to live your standard of living. And there are a couple of things they can do here. Some it's not necessarily unpainful, but there are things that you could do. The first thing you need to do is to review all of your expenses. So you need to itemize them, write them out, type them into a spreadsheet. We have a spreadsheet that we're giving away as a part of this whole this podcast for certain people. But put them into a spreadsheet, see what they are, then look at that and say, okay, is there anything here right now that is not as important to me as avoiding debt? Is there anything? Hopefully there is something. You would be reducing your standard of living, but you're trying to avoid getting into a debt spiral, going negative in terms of your cash flow. As that's technically what guys like me would say, trying to avoid that. So, is there something that you can live without that just isn't that important to you, that you maybe had been spending money on, but that you can give up easily to avoid going into debt? And then you have to have the discipline to give that up. You make that decision, and you have to have the discipline then to give that up. A
I feel like
second
this is
thing,
a, oh yeah, I have something to say on that one. I feel like this is a big thing for people. And I think that social media has made it a little worse for people because it's much easier to compare yourself to others and what their life is looking like and their lifestyle and the things that they have and blah, 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 blah. And I think that people are really trying to keep up with the Joneses, but the Joneses is, all of your friends on the social media sites, all the people that you are vicariously looking at their life. And I think that this is, yeah, probably a really hard one for people to say. I think what I love about all this stuff that we're talking about is it's very, there's no gray area. The numbers don't lie. Like what you're making and
right?
what you're spending, like it's very cut and dry. And if you are spending more money than you have to spend each month, like you have a problem, and then therefore you need to take action on it. And this has to be not based on your emotions to the thing. Like it has to really just be from that black and white space of I need to change something.
Well, you're raising something that is in an area that we call behavioral finance, the psychology of money. The psychology of how we feel about ourselves relative to money,
Mm,
relative to wealth, relative to spending. And it is a major, major thing in the United States that people look at other people and they want to, as you said, keep up with the Joneses or the Smiths, as the situation might be. Um, and it's an unhealthy thing, obviously. Each of us simply is where we are. Um, One thing I can tell you is that other than Elon Musk at the moment, there will always be somebody wealthier than you. And there's pretty much always somebody not as wealthy as you. And just simply accepting that and not making comparisons with other people is a much healthier way to go through life when it comes to your finances. Your finances should bring you joy, and they should bring you, contentment with your life, fulfillment with your life. Um, there's a saying, uh, I I'm happy with, well, I'm happy because I got everything I wanted, or I'm happy because I want everything I got.
mm,
Okay, you know, we're all where we are in life, and it's, as you said, the numbers don't lie. We just simply are where we
yeah.
are, and it's the result of how we were raised, our education, how hard we've worked, our value system, philosophy, the opportunities that were available to us, and how we took advantage of those opportunities. I mean, those are kind of the variables that determine where people end up in life. And uh, whether you're doing as well as someone else or not, uh, it is a poor way to go through your life if you're always worrying about that. And I'll say that number one, behavioral finance. Number two, social media. Um, and everybody knows this, but we all put forward our best foot on social media. You know, we rarely take pictures of ourselves the moment we wake up in the morning when we're, we look like our hair is all messed up. Not in my case, but people's hair is messed up and they look drowsy
Oh,
or hungover or whatever.
yeah,
That's not the picture that we put
right.
on Facebook for the most part. Um, so we're sharing moments of joy. Now, some people share times of sorrow, times of challenge in their media posts. But I think there's less of that among young people. I think people of my generation tend to be more real with what they post. Um, I think the younger generations, your age and a little above you and certainly below you, they tend to see things, ooh, I have to show everybody how great things are for me.
Yeah. Yeah.
And it is a problem. It is a problem. Your life is your life. And if you're grateful for your life as it is, in general, you should be able to find happiness. And worrying about what other people are doing and what they're spending, it's not getting you there. Not going to get you there.
True
Let me get
that.
to can I get back to my
Yeah, we have two
to the
more. I know
list?
we could be here. This is like an hour-long podcast now, so we'll we'll
Right.
we'll wrap
These
it
are
up.
philosophical things
We'll
too,
wrap it up.
so okay. So another thing that you can do, and this applies really only to people that have a mortgage, and if the mortgage is intended to be paid off faster. So, for example, you have a 30-year mortgage, but you're paying it off at a rate that would pay it off in 15 years because you'd like to be done with it sooner. Or you have a 15-year mortgage, or you have a 10-year home equity line. There's a certain payment rate, payment dollar amount monthly that goes along with that number of years of payback. And with mortgages, the longer you take to pay it back, the lower the payment is. So, all other things being equal, it might be possible to refinance that debt to a longer time period. Or ideally, if you're trying to pay it out over 15 years, pay it back at the normal rate for the time being while your costs are going up rapidly. And again, until you kind of catch up from an income standpoint to expenses at some point in the future. Both of those ways of handling things could result in you having more cash flow available to meet the increase in your expenses. The final thing to do is really is to look at what you're spending on things and see, where could I somehow cut this? Where is there somewhere that I can renegotiate something? Can I get my rent lowered somehow? You might be able to. I mean, it depends on what's happening in your local real estate market, but you might be able to get your rent lowered. Can I use coupons more? Can I look for sales more so that when I'm purchasing things, I'm getting them at generally lower prices than if they were just at their full retail cost? If you look for things that way, you can help to cut your costs. And remember, what we're trying to do is we're trying to cut the costs by the amount that that inflation has risen and is hurting us. So that might be $1,000 or $2,000 a year. Well, can I chop that much off in costs? If none of the other 9 things we've talked about can help, can I chop off enough in these costs to reduce what I'm doing, or reduce what I'm spending, and be in at least a status quo place financially to where I was a year prior, even though the rate of things continues to go up faster than your rate of income. And really what we're looking for ultimately is for your rate of income to go up faster in the future than the rate of inflation at some point. That kind of helps you catch up. Now, that may take some years. And American society is used to having things at our fingertips today. We're not used to having to wait years for things to work through. But in personal finance, that's kind of a normal timeline. I mean, you have to save money for 30 years to be able to retire one day. Well, it doesn't happen overnight. It happens in 30 years. And I can tell you that 30 years is going to go pretty quickly, because for me, it certainly has gone pretty darn quickly. 40 years has gone quickly for me. So it may feel to you as though it is, a timeline that you can't stand to wait. But that's again where discipline comes in. That just is the way that things are. It's just the nature of personal finance, that sometimes things take longer than you would like. But by being disciplined, by persevering, that's how you ultimately will get ahead again when things are better.
Yeah. Yeah. These are really good tips. And I think this idea of discipline is a little bit like out of the younger generation's lexicon these days, because we have Amazon and quick, fast, fast, fast. So
yes.
I think bringing this in is helpful. And I'm just going to add one more thing of my own perspective on this, is being grateful for what you do have. You have a job, you might have a house, you might have food to be able to put on the table. I think, these times can be very trying if you're really struggling financially, but to just be grateful for what you do have in front of you. And I know this is not a financial planning tip, but maybe just a life tip for anyone listening.
Yep.
I love that.
No doubt.
Well, thank you so much, Dad. This was a cool episode today. Make sure that if you're listening, you have downloaded our inflation survival guide. It'll have all these 10 tips on there. It also includes our budgeting template. So if you want to be able to put your own numbers into the template and the formulas that we've already created, so your income, maybe you have a second job, and go through all of your expenses from rent to mortgage to car payment to subscriptions to just help you get a better handle on your finances. You can take a link or grab the link in the description of this episode today. And yeah, thank you so much for being here. Thanks, Dad. Cool episode.
Okay. Great to be with you, Bridget. Thank you very much for being such a wonderful host.
Thank you. If you liked this episode, make sure to subscribe, follow, comment, rate, review, and share this with a friend who needs to know a little bit more about personal finance. See you soon.